Hey, what is going on, guys? My name is Nick, and in today's video I'm going to be sharing 3 Canadian high-yield dividend stocks to buy for cash flow in 2022. These 3 stocks all have high yields and a solid track record of paying dividends, so if you're an investor looking for sustainable cash flow, you're going to love these stocks. Anyways, make sure to stick around until the end to figure out what TipRanks analysts think about these stocks, and with that said, let's get straight into the video. Alright, now the first dividend stock for cash flow today is TransAlta Renewables with ticker symbol RNW.TO. TransAlta Renewables is a subsidiary of TransAlta Corporation and is one of the largest publicly traded renewable power generation companies in Canada. In particular, TransAlta Renewables is well known as being one of the largest generators of wind power in Canada. But they also develop, own, and operate hydroelectric plants, natural gas plants, and solar farms across North America, so it's a very well diversified and stable utility company. Here we can see the stock has done quite well over the past 5 years, being up about 50% including dividends, which is not too bad for a utility company. So now here's why TransAlta Renewables is an amazing dividend stock to own. Firstly, TransAlta Renewables pays monthly dividends, so instead of receiving a dividend on a quarterly basis, you're actually going to receive one every single month. Secondly, RNW stock has a high forward dividend yield, which is currently sitting at about 5.4%, and this is significantly higher than many other great dividend stocks in the market today. Thirdly, TransAlta Renewables has incredibly reliable income as they are a utility company. Now, if we head over to TipRanks and see what analysts think about RNW stock, we can see that all analysts have an average price target of $19 per share, which is representing only about 8.5% upside, and the same thing goes for the top 5 analysts too. Now, there are only 2 main issues I can find when it comes to RNW stock, and that would be a high dividend payout ratio, but also little to no dividend growth over the past 5 years. In the trailing 12 months, RNW generated $1.03 per share of cash available for distributions, or CAFD, while it paid out 94 cents per share in dividends, equating to a payout ratio of 91%. Furthermore, management says they're targeting a 2022 payout ratio range of 88% to 102%, which is much higher than most other lower yield dividend stocks in the market. However, aside from these small issues, TransAlta Renewables would definitely be on my radar as one of the best Canadian dividend stocks to own for cash flow. Anyways, moving on to our second Canadian high yield dividend stock today, and that would be Manulife Financial with ticker symbol MFC.TO. I'm sure you've heard of Manulife before since they are the biggest insurance company in Canada, but they also offer several different financial products and services like bank accounts, investment management, and so much more. As we can see, MFC stock really hasn't had great performance over the past 5 years, only being up about 23% including dividends, and without the dividends, the stock price is actually down. But the reason why investors love Manulife stock so much is because of their reliable, lucrative, and growing dividends. Currently, MFC stock has a forward dividend yield of 5.6%, which is very attractive, and based on their quarterly dividend of 33 cents per share, they currently have a payout ratio of about 40%. For 2022, Manulife's management is targeting a dividend payout ratio range of 35 to 45%, so they are well within this range already, and I think this provides them with ample room to increase the dividend moving forward. In fact, Manulife has been consistently raising their dividends since 2014, aside from when they held it constant for a year and a half in 2020 during COVID, but then more recently in 2021, they increased their dividend once again by a whopping 18%, which is definitely made up for the lack of an increase in 2020. Finally, we can see on TipRanks that all 11 analysts have an average price target of $27.20, being about 15% upside, while the top 9 analysts have an average price target of $26.87, being upside of about 14%. So overall, I believe Manulife is a great dividend stock to own for cash flow and for growth in the dividend, but if you're looking for capital appreciation, I would personally pick a different stock. Finally, the third dividend stock for cash flow is none other than the Canadian Imperial Bank of Commerce, also known as CIBC, with ticker symbol CM.TO. The Canadian banks are notorious for being quality dividend stocks, and CIBC is no exception. While CIBC might be the smallest of the 5 big banks in Canada, I believe it's one of the best dividend payers of the bunch, and it also has the most room to grow. In fact, one reason I picked CIBC is because they recently reached an agreement with Costco to be the banking provider for their Costco MasterCard across across Canada. I think this could be a huge growth driver for CIBC, and it could definitely help out with the dividends. In terms of the stock, CIBC has been the best performer out of these three stocks today, having gained about 68% including dividends over the past 5 years, which isn't bad at all for a bank stock. And with the stock trading down about 15% from recent all-time highs, that means the dividend yield has gotten even juicier than before, so right now could be a good entry point. Currently, CM stock has a forward dividend yield of 4.7%, which is quite attractive on top of their capital appreciation. We can also see here on TipRanks that CIBC has a dividend payout ratio of just under 40%, which is very manageable long term and has lots of room to grow. In terms of their dividend history, CIBC has grown it very consistently over the years, where they did pause dividend increases after the Great Recession in 2008 and in 2020, but they haven't cut it any time in recent history. Furthermore, we can see here that CIBC hasn't missed a regular dividend since its first dividend payment in 1868, which is absolutely incredible. Finally, on TipRanks, we can see that all 11 analysts have an average price target of $80.36, being about 15% upside, while the top 8 analysts have an average price target of $81.25, being upside of about 16%. So although CIBC stock has the lowest forward dividend yield out of all the stocks we discussed today, I do still think it's very attractive, and I also think CM stock has the most potential upside due to their deal with Costco. Anyways, the 3 high-yield Canadian dividend stocks to own for cash flow are TransAlta Renewables, Manulife Financial, and CIBC Bank. So make sure to leave me a comment down below with your thoughts on all 3 of these stocks, and with that said, I will see you in the next one.